Hello, traders. Gary Wagner here. It is 11:33 in Honolulu, 5:33 in New York on Tuesday, 11th day of October, 2022, and this is the daily report for gold and silver. Gold today did close higher in New York. In fact, it opened at $1,675, traded to a high of $1,691.30, and is currently fixed at 1673.20. Obviously, current pricing is much closer to today's low than its high. Now, the dollar had minor strength, so there was not a big influence in terms of gold, at least. The dollar itself is up 0.09%, but it is at 113.17, so back near the highs. It would have to take out approximately 114.75 to hit a higher high than we've seen in 20 years. Silver did sell off moderate to strong today, giving up 2.4% or 47 cents, with the most active December contract currently fixed at $19.14.5. One of the things that we do want to note is yields in U.S. debt instruments were higher in both the 10-year note that we were just looking at and now the 30-year bond. And that, of course, would be highly supportive of the dollar and would pressure gold lower. Traders, unquestionably, we have seen gold prices drift lower since March of this year, when gold hit its record high for the year, $10 shy of the all-time record. Typically, when we view an area chart, we kind of average it or do it off the closing price. I want to look at an area chart in two ways. First is based on the high, and that's what I have up. So it will exaggerate a series of lower highs, and then we'll look at it based on the low. Of course, it's clear that we have had a consistent series of lower highs. And it's quite evident when we look at the magnitude between the prices, this one being at around 2,078, then to 2,000, then to well below 1,900, about 1,875, this one at 1,825, this last one well below 1,800 at around $1,730. Clearly, that says we are still in a bearish scenario or a bear market. As you can see, we are still looking at a weekly gold chart in area format. However, this is based upon the lows. And what we can see is we also had a consistent series of lower lows. We can use this as our first low here. That comes in around 1,900. This second low comes in just around 1,775, so about a $125 difference. So when we go from 1,775 to the next low, that's 1,675. In other words, from low to lower low was about $100. The last low to low was a little bit more shallow, 1,675 to 1,625. Does that mean that we're seeing a possible conclusion to this series of lower highs, lower lows in the bear market? I would have to say not. It's fundamentally driven on the fact that the Federal Reserve has been extremely aggressive in raising rates. Now, the CPI will come out on Thursday. The forecasts are anywhere between 8.1% and 8.4% by polls of economists taken by Bloomberg and Wall Street Journal. However, when you average them out, the consensus is we will see a downtick in inflationary pressures vis-a-vis the CPI, which includes food and energy costs, from 8.3% the prior month to 8.1% in September. However, the Federal Reserve does have an edge on forecasting in that they have a predicting model that uses real-time daily data. It's the inflation nowcasting system. It has been developed and used by the Federal Bank of Cleveland. Not only have they identified their forecast for September, which they believe is going to come in at 8.2%, but they're also putting out October, and they are saying that that will show a downtick to 8.04. The one thing that we are seeing is that the core PCE is still rather high, and that's not coming down, and it is the core PCE as well as the core CPI that the Federal Reserve really focuses upon. However, I believe that regardless of what numbers come out, they already have made up their mind to at least do a 75 basis point rate hike in November, followed by something to the magnitude of either 0.5% or 3/4 in the last FOMC meeting of the year. And I believe that by the end of the year, the Fed funds rates will be somewhere between 4 and 4.4%. I wouldn't be surprised to see it go as high as 4.5 to 5% by the first quarter of 2023. That will continue to put bearish pressure unless some fundamental event changes market perception. It could be anything like the Russians getting out of hand, North Korea doing something absurd and crazy. But all things being equal, the Fed is going to continue to tighten until they believe or they're satisfied with where current inflationary pressures are. It is for that reason that we're remaining with a neutral stance with a bearish bias. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the next daily update and review.